Excellent. Thanks, Kelly. So my name is Ron Kuehl. I am a managing director at a private equity firm in Chicago. Frontenac Company is the name. We've been in business for 50 years, and we focus on partnering with management and driving value and growth. I'm joined by three folks. They'll introduce themselves. The title of our panel is technically how to improve cash flow now. There will be more than a tad bit of scope creep. We'll speak more extensively about value creation, and the two are obviously intimately linked. So maybe Scott, do you mind introducing yourself?
Sure. So my name is Scot Duncan. I'm one of the founding partners at MiddleGround Capital Partners. MiddleGround is a relatively new private equity firm. We're focused on industrial, manufacturing, and specialty distribution companies in the lower middle market.
John?
So John Dupuy, I've got about 20 years in private equity, working as an operating partner at the fund level, as well as a CEO and interim CEO at portfolio companies. I'm currently an independent operating partner working with private equity firms on industrial investments, both pre and post acquisition.
Excellent. Miles?
I'm Miles Lee, CEO of Alliance Cost Containment. We help private equity firms and their portfolio companies improve cash flow through the reduction of their indirect procurement expenses.
Excellent. So format, we will go until about 2:20 Eastern time, then we'll leave some time at the end for questions. So let's launch in. Scott, you've been in the industry for quite some time, actually in industry, an operating person within private equity, and then founding and leading a private equity firm. That's not a comment on your age either. It's a lot of experience. Over time, what changes have you seen in terms of when value creation planning is taking place?
Yeah, so just a little bit of background. I'm in charge of the operations team at MiddleGround Capital, so everything that has to deal with our portfolio companies and working with them. We have an internal operations team of about 16 folks now, and we're looking for more as we grow. So I would say, generally the answer to that is earlier and in more detail. Our operations team gets involved pretty soon after the deal team. If we see a deal that we know that we like, as soon as we get access to data, the operations team is in the data room, searching through the material, trying to pull out some of the key performance indicator of the business and comparing it to some of the other businesses that we know to go ahead and put together a value creation plan. Now, if we get signed up, as soon as we get signed up at the LOI phase, when we go into post LOI diligence, and hopefully we have exclusivity, but sometimes that's not always the case anymore. We bring in multiple third-party vendors that we've worked with for several years, and so sometimes we have 3 or 4 third-party consultants doing diligence right alongside us. Through the course of that, leading right up into acquisition. So, we lean on a lot of those people for cost reduction, opportunities for them to kind of quantify that for us, and others for, working capital opportunities as well.
Makes sense, and it's a good sized team you've got in your operations group. Underscores the importance increasingly of that pre-closing value creation planning work. Miles, maybe over to you. You've got a long-standing, highly successful specialist of sorts consulting practice. Maybe just comment when you work with PE. When are you typically getting involved? And then as of closing, where do you stand in terms of pre-planning, prioritization of initiatives in your area, and then implementation planning?
Sure. So, oftentimes we'll go in pre-acquisition, we'll go into the data room and, collect a certain amount of data required, and particularly around the procurement area. will help the sponsor identify a realistic expectation for what cost savings could potentially be available post-close. And we'll quantify that the first 12 to 18 months. And oftentimes that's particularly useful to a sponsor in a competitive bid situation where they can keep that number in their pocket or use it as they may. But our, with our background in research, it's a fairly reliable savings projection pre-close. We also will help identify any supply chain risks that we see that may help prevent unpleasant surprises post-close that maybe they didn't see in the data room. Once the deal's closed, we generally will be brought in the first 60, 180 days. And depending on the type of company, whether it's manufacturing or service-based, we'll prioritize the actual expense categories based on the annual spend and what we perceive to be the annual savings opportunities. And that, like I said, that can vary by industry.
Makes sense. It makes sense. How do you find with private equity firms on a pre-closing basis? How do they interact with you? Do you have the same clients consistently? So you've got that working relationship that's comfortable. What's the rapport like with your PE clients?
Yeah, good question. So oftentimes we'll start kind of smaller in scope, prove ourselves, and then once the PE firm can experience the value of what we deliver them, then we'll become a trusted advisor, and we'll get the phone call for assistance both on platform and add-on investments. And not every close results in an implementation of savings. There may be other priorities. But if one of the top priorities is improving cash flow and EBITDA out of the gate, they'll generally, the same group of sponsors that we've worked with for years will generally take us in and lead us through that and get us involved early on, I guess in the first 3 to 6 months. Sometimes though, there may be other priorities and we may not get involved until a year or so after close. It just kind of depends on the situation.
That makes sense. That makes sense. John, maybe kick it over to you. I joke, but on LinkedIn, if you look at John's profile and background, he's covered everything from manufacturing to service, distribution, consumer businesses. It runs the gamut. I'd maybe in this question, this could be a college course, but as you think about manufacturing, service, distribution, et cetera, is there a way where you'll accentuate different elements within the value creation template that become near-term priorities?
Most definitely. It comes down to understanding the business model, how the economics are driven, applying an 80-20 rule on what's the most important thing in your value creation plan, and then just tailoring it. So you do have kind of a smorgasbord of things that you can look at, but depending on the business and what's the most critical lever, that's what I've traditionally focused on. And you'll have commonalities because even in like a gifting business for Mrs. Fields Foods making cookies, there's a lot of supply chain issues there that we went after and, to good results. So again, you can find commonalities in businesses if you really just get underneath them.
Makes sense. It makes sense. I think, as we talk about prioritization, as you transition from pre-closing to post-closing, not a consultant, but all the McKinsey and Bain folks out there will appreciate, we think about a 2x2 matrix where you have on one of the axes, you've got most impactful, and then on the other, you have, for lack of a better term, easiest to accomplish. And the old adage, there's no time like the present. Certainly that's true, but in the words of the former president Calvin Coolidge, we can't do everything at once, but you can do something at once. Scott, how do you think about what you do up front, and then how do you follow that up with initiatives 2, 3, 4, et cetera?
Yeah, so for us, we really prioritize the cash generation initiatives in the value creation plan right up front. And so those are the first priorities for us, as well as onboarding the company on, reporting, financial reporting, so that we can make sure we have pretty, clear line of sight to how the company is performing as early as possible. But yeah, we actually prioritize the net working capital items. We feel like it's good to go ahead and generate as much cash as possible immediately. Therefore, we can use that to pay down debt and delever the company, really quickly. But the management team has complete line of sight to our entire value creation plan, every target that we have in place, and everything that needs to be achieved throughout the ownership. And we'll immediately follow up on some of those net working capital items with some of the other longer term items as well. We'll bring in our own resources as necessary to help support those. And as Miles mentioned, we do the same thing. If we bring in an advisor and they give us some good advice on what the opportunities are, we'll soon after acquisition tap them on the shoulder and say, okay, you said you could help us in this way. You could help us save this much money. Now, go do it. And so, we'll line up other people as we need to as well.
Absolutely. I think so. Back to you, John. You've been on both sides. You've run several businesses, and you've also been on several boards as well. How do you think about that process in terms of prioritization, execution and implementation plans, and the push and pull, if you will, from a consensus building point of view? And so that. Feel free to comment on your interactions with the private equity firm or as a board member with the management team. What are some potential pitfalls as folks are just learning how to work with one another, and then also the expectation to make significant progress is there?
Well, of course, especially when we're talking about lower middle market companies, private equity can be a bit of a shock to them. Of the intensity, the data approach, making, decisions based on hard analytics. And so we always work on the value creation plan up front with the management team. And we're not going to have it 100% correct, but, day one, but it's a basis of, these are the things that are really going to, move the needle here. We've got a lot of other things we'll work on, but do we all agree that these are the key things that's really going to drive this investment forward? And then after that, really working with the team in a collaborative basis. In one area is like when you get into cost initiatives, it's so important to really involve the management team, listen to them, analyze things. You're going to push them, but don't push them too far, and definitely don't ever dictate, but it's kind of there that we get out there with them and say, let's try this, and we need to get out of their comfort zone, and we're not right on all of these things. And hey, just recently with one company I was involved in, middle of the pandemic, we needed to generate cash flow. And I started talking about price increases. And people started telling me how crazy I was. And I agree, I'm crazy. But there's always tactical things that you can find to go after, even on the pricing level in the middle of the pandemic, such as low volume customers, low margin customers, too much discounting, and just try some things, and we can always pull back on them.
Yeah, absolutely. And that is an uncomfortable topic when the demand environment is sagging, but you want to move price upward. You made one point as far as you work on the value creation plan up front with the management team. I think the way we think about it is really four key contributors to that. You've got the owners, Frontenac. You've got the incumbent management team, and the incumbent team is inevitably sitting on 3, 4, 5 latent ideas that for many different reasons, the owner has just said steady as she goes. Let's stick with what we're doing. Thirdly, we'll have our CEO first partners, which think of as industry experts that'll come in and become the board or the chairman or a CEO in some instances, and then our third party advisors, which play a really critical role there. I was gonna ask Miles, maybe back to you. We're always interested in which initiatives, whether it's strategic pricing or working capital optimization or purchasing, which of those, at least on the cost side, the expense side, the purchasing side, how are you involved on the front end and then shortly after closing for the time frame that you had outlined? And then is there an ongoing piece where continuously or periodically your clients are saying, hey, every year, Miles, I want you in there helping us to make a few dollars of savings consistently?
Yeah, sure. So I totally agree with John's point of view. From our philosophy is to get involved with really truly understand the culture of a company. I mean, once we are partners with a PE firm, then they bring us into a company to drive procurement cost savings. We really need to understand the culture, meet with the stakeholders, understand what initiatives they either have tried in the past and haven't succeeded or haven't tried and why. And then we pivot to more of an action emphasis. Let's identify a handful of areas with, in procurement with your spend with your suppliers where we know we can win quickly. And we do it in a way that's non-invasive and doesn't tie up the operations. And then we found once that first wave of wins that maybe generates, $400,000-$600,000 of EBITDA improvement annually, then the bigger initiatives start to fall in more seamlessly. We do not recommend, or at least it's our position, to not try to bite off everything at once, to really try to build the credibility through early wins. And then on an ongoing basis, it's very, very important. And again, from our standpoint, I'm coming from the procurement cost savings angle, is to really truly audit and measure the results. It's fairly easy to negotiate a competitive price with a vendor that shows savings on paper, but that doesn't always flow to the bottom line unless you're truly measuring it. And we actually will, on an ongoing basis, to answer your question, Ron, we will audit the savings every month for a 2-year period once in every category that we're involved, once a company engages us. And sometimes that usually leads to re-engagements or expanded categories along the way. And you may talk about it later, but as a company's exiting, that audit can then be used in the Q of E because it's very solid savings that's going to be carrying forward. And so know the team, understand the culture, have quick wins, build on them, and then measure like crazy the value that's hitting the bottom line every month.
It makes sense. I mean, I think as we interact with our companies and think about, I think there's much that's lost just in saying, okay, we're perfect at indirect spend now, or we've got it in house. We don't need you anymore, Mr. Specialist Consultant. I think what we find that's beneficial is you do that work up front, you implement, and then you're either doing health checkups every year, or you're having the same project executed continuous. And that's continuous improvement that's needed to have savings there in order to offset particularly what's now increasing wage and labor and other cost pressures. So I maybe we have a question. This is about when COVID hit last year. Did your portfolio companies have credit lines to draw upon? I would say for all of our dozen companies, we did. We drew upon those in early March, plus or minus. That I believe it was. Banks did not materially push back on that concept. Scott can attest to this. If you had done this in 2008, you were ahead of the curve. Oh my gosh, that was a great idea. Now, if you didn't do it within the first week, you're you're asleep at the switch. The good news is, and I'd say most companies, certainly all of ours, we were fortunate, drew down those revolvers and really paid those back reasonably quickly as working capital management, expense containment, et cetera, caused not the default rates here in this downturn were much less severe than they were in prior. So I'll maybe transition there. We're on the COVID topic. It's tricky. You've got supply chain disruption on one hand. You've got domestic and international sources of supply. We're talking about cash flow and unlocking value there. But safety stock levels versus the cash flow and debt pay down topic. Scott, you hit this hard from an operating side. How do you balance those two competing interests?
So what I would say just generally with our portfolio companies is that we find that that there is an inherent tendency to make sure that there's enough inventory, and that we find that happens at all of our companies. The tendency being that potentially somebody let something go and didn't order something at some point in history, and they were reprimanded and told never let a company run out of inventory again. And so what we find is there's a lot of opportunity to professionalize and bring systems into place at our portfolio companies that really drive visibility into where inventory is needed and where it isn't. The companies that we're working with don't always have that capability. We like to bring that into play first and just be very pragmatic about where inventory is needed and where it isn't. And it's a data-driven exercise. It's not a feeling. It's not an emotion. It's all based on data, and we use that. Occasionally there might be a slip up or two, but we find that to be much more the opportunity set that we find versus the opposite, where people are running a little too low on inventory or too low on safety stock.
Sure. Yeah, you don't want to miss sales, because with sales comes EBITDA, and EBITDA times a multiple gets you equity value. So that's ensure you're making the right economic trade-off. I'd say, so with many of our businesses, we're squarely in sort of the 5 million to 15 million of operating income is our target new platform. You guys, Scott, are a little bit up market from where we're at, but the businesses we invest in, they're never perfect. And so there's some form of investment that's needed, ideally right up front. We've got human capital and key leadership positions. Oftentimes there's systems, as you had indicated. And there's the you could do everything at once and add $2 million to your overhead, so to speak, or term those things out. And it's a delicate balancing act how you want to roll those costs in. So I John, I'll maybe kick it back to you. COVID may be a good example. There's others as well from a past economic downturn standpoint. So say you bought a business 6 months before COVID hit. You've got this great set of plans, great implementation strategy, prioritization. Now COVID hits and no one knows what this is going to look like for the next 6, 12, 24 months. Stuff changes. you're in a difficult spot because you can't see the future or even have any sense of it. How do you react when everything goes up in the air pretty much overnight?
Well, I was actually running a company as interim CEO when COVID hit, and that was a little fortunate as an ex-consultant and someone who's done a lot of distressed. I do growth and distressed investments, and we were able to act very quickly. And we matched our supply and demand. We started doing layoffs in early March, and we were able to pretty well maintain our EBITDA margin. We didn't have quite the EBITDA, but the margin was there by being very quick in terms of controlling our cost And of course, with the layoffs, we didn't fire people. We'd already leaned out what we needed to, but keeping them close, giving them the benefits, bringing them back as soon as we could. But also, in these times when you're really shifting to a full breadth of generating cash flow, you got things in the value creation plan, but this is different. This is really scrutinizing all non-discretionary spending that you can. You're pushing off CapEx wherever you can. You're really going after AR and AP. In one area in particular, you got to stretch. It's not comfortable, but your vendors are doing it, everyone's doing it to each other. So you have to have a very solid plan there and knowing by vendor what you can do, negotiate with them. And then if you have a plan, stick to it. If you tell them, I'm going to pay you $200,000 next week, you got to pay them the 200. And one thing I would say is you can't just leave it up to the CFO. Really, the CEO and the board have to make sure that, it's a formulaic plan and you're sticking to it.
Absolutely. I mean, I think it was a in the COVID downturn, we thought we were exceptional because our companies all did fairly or very well. And if you talk to others in the marketplace, it's not uncommon that many or most private equity firms in their portfolio companies perform reasonably well. I mean, I think we look at it and say that aggressive management of headcount, their folks have a plan and execute on that plan in a clinical, non-emotional manner. I mean, I think at least for our Scot, I'm sure you saw this as well, where it's manufacturing business or for us distributors, you see inventory reductions, receivables reductions. Not a technical term, but you kind of eat the balance sheet, so to speak, and so manage down your debt balance. That was a short source of cash flow as well. And then in many companies that have both a project or a capital dimension to their sales versus service and aftermarket, we saw as well where the bigger ticket, more capital items declined. Those were our lowest margins, and aftermarket parts, service, et cetera, are the highest margins. And so the business has pivoted really towards higher gross profit margins. And a little bit, John, to what you said, we saw our margins hold steady or in many instances go up. So I think the sophistication in navigating those, the choppy waters really was there was a high degree of high quality management doing that. Maybe I think we're nearly out of time here. Miles, I'll last question to you. Were there clients of yours who said, "Hey, we need savings. We need to preserve earnings"? Did you have many folks that had the foresight to come in and say, "The purchasing area, that's where we can save"? Or were private equity firms and their portfolio companies more focused inward and on managing their overheads and their headcount more broadly?
I think procurement cost reduction is becoming maybe a little more mainstream in the thought process with sponsors. At least we're seeing that, whether we're involved or not. Some of the larger sponsors are actually building teams of people that do nothing but procurement cost, management. So for those that it's already you've created an awareness, you can create EBITDA and cash flow improvement without doing anything that's customer facing. That's appealing. And generally speaking, if there have been decent vendor relationships with the portfolio company historically, we can take that good work and help drive costs quicker. So we're seeing more and more that it's we're part of this procurement cost reduction initiative is part of the first 90, 180 day team of value creation. And I think a lot of that's just some of the larger firms years ago started to build in-house teams, and that's kind of trickled down to mid-market. And so we're seeing and hearing more and more of that as a common solution.
No, absolutely. And I think some of that is compartmentalizing the various value creation streams and ensuring that you have a single owner of that. And you can do a couple things at once, particularly like Scott, you've got the 16-person operations team. You can use this trusted network of third-party advisors and pulling in. I think increasingly we have this with our portfolio. Each one of the businesses that we invest in within the first month after will create a level 1 and level 2 downside or recession planning document. And so if things go bump, we're immediately pulling that out of the drawer, and you get started on that. Take very aggressive early action. I think we are at time. Let us we'll wrap here, and I think Bob, you'll transition us into the next topic area. Thank you so much, Miles, John, Scott, and everyone who attended.
Thank you all.
Thank you.
Care.